For over a decade, you've heard the same pitch. Bitcoin is digital gold, a scarce, modern hedge against inflation and chaos. Just like the real thing, but better. This year, the financial markets ran that exact experiment in real time. Real geopolitical crisis, real inflation pressure, real chaos. Bitcoin started 2026 around $88,000. It is now trading mere $59,000, down roughly a third. Gold, over that exact same period, surged to a record high above $5,600 an ounce. The two assets that were supposed to move together as twin hedges against the same risks did the complete opposite. One respected Morningstar contributor put it bluntly after reviewing the data. Calling Bitcoin an inflation hedge was industry propaganda, and this collapse provides the proof. Today, we're going to walk through exactly what happened, why these two assets diverged so dramatically, and what this actually means for how you should think about either one in your own portfolio.
Here's why this matters beyond just crypto traders watching charts.
Millions of ordinary investors bought into the digital gold pitch specifically. Not because they wanted to gamble, because they wanted protection. A hedge against inflation eating their savings, against the dollar weakening, against exactly the kind of geopolitical instability the world has seen in 2026. And then the test actually arrived. The US-Iran conflict began in late February. Oil prices spiked. Inflation climbed to its highest readings in years. This was precisely the environment Bitcoin was supposed to shine in, according to the pitch. Instead, Bitcoin fell over 50% from its October 2025 peak of $126,000, at one point dropping below $60,000 and breaking technical support levels that it held for months. Gold did exactly what it has done for thousands of years. It went up.
Here's the mechanism behind this divergence, and it comes down to one critical difference between how these two assets actually behave in markets. Bitcoin's 6-month correlation with the Nasdaq reached 92% in recent data. That number is the entire story. A correlation that high means Bitcoin isn't moving independently based on inflation or currency debasement. It's moving almost in lockstep with tech stocks. When the Federal Reserve signals a hawkish stance, holding rates higher for longer, institutional risk managers don't sell gold. They sell across their entire risk-on allocation bucket. Bitcoin sits in that bucket right alongside Nasdaq futures, so it gets sold at the same time for the same reason. Gold sits in a completely different bucket. It's the asset risk managers buy when they're selling everything else. Remember that pitch from the beginning of this video? Bitcoin as digital gold, a modern hedge against the same risks? Here's the volatility comparison that exposes why that comparison never really held up. Bitcoin's annual volatility runs roughly 45 to 60%. Gold's volatility sits around 12 to 18%. That gap explains everything. Bitcoin can lose half its value within months. Gold, historically, does not behave that way, even during genuine crises. There's also a structural difference in who's actually buying each asset right now. Central banks around the world are expected to purchase around 755 tons of gold this year, as governments quietly diversify away from dollar-heavy reserves. When central banks are your biggest buyers, an asset's price has institutional support that retail-driven speculation simply doesn't provide. First,
Spot Bitcoin ETFs experienced a record outflow streak between mid and late May, draining nearly $3 billion from total assets in just 10 trading sessions, the longest redemption run since these funds launched. Second, and this one carries real symbolic weight, Michael Saylor's company Strategy, the largest corporate holder of Bitcoin on Earth, with over $61 billion in holdings, sold Bitcoin for the first time in 4 years at the end of May. The dollar amount sold was small, roughly $2.5 million. But after years of being the most visible, most vocal, buy and hold forever advocate in the entire industry, even a symbolic sale rattled confidence across the market. Third, the technical breakdown itself. Bitcoin had defended the $65,000 level multiple times throughout early 2026. When it finally broke decisively below that floor in early June, it triggered over $800 million in forced liquidations within 24 hours, as leveraged positions across the market got automatically closed out. None of these three events were about inflation protection failing. They were about Bitcoin behaving exactly like what it structurally is: a highly leveraged, sentiment-driven risk asset, not a defensive store of value. To be fair to the other side of this debate, it's worth noting that gold has pulled back somewhat from its January peak too, and some analysts do see a path where rising oil prices and a hawkish Fed could pressure gold lower before year-end. Neither asset is risk-free. But the magnitude and direction of the divergence this year has been Here's the honest, practical takeaway, regardless of whether you own either asset right now. Move 1. Stop treating Bitcoin as a short-term inflation hedge or crisis insurance. If you're holding Bitcoin specifically because you want protection during a market panic or an inflation spike, this year's data argues directly against that use case. It has repeatedly fallen during exactly the moments it was marketed to protect you. Move 2. If you still want crypto exposure, treat it explicitly as a high-risk growth asset, sized accordingly. Some respected analysts still see a legitimate long-term case for Bitcoin as a scarce asset over a multi-year horizon, separate from its short-term safe haven failures. If that's your thesis, a small position, sized like venture capital rather than like insurance, is the more honest way to hold it. Move 3. If your actual goal is inflation protection or crisis insurance, gold, tips, and short-term treasuries have a much longer, much steadier track record of actually doing that job. Gold's 12 to 18% volatility compared to Bitcoin's 45 to 60% isn't a minor statistical footnote. It's the practical difference between an asset you can rely on during a crisis and one that might just add to your stress during one. Move 4. And this is the one with the broadest lesson, beyond just these two assets. Be skeptical of any asset class marketed primarily through a comparison to something else, rather than its own track record. Bitcoin didn't need to be called digital gold to have a legitimate investment thesis. The comparison was a marketing shortcut. When the actual data diverges this sharply from the pitch, it's worth asking the same question about any other asset sold to you through a comparison rather than its own evidence. Bitcoin may very well recover. It has after every previous major correction. But recovering in price and fulfilling the specific promise of inflation protection are two completely different things. This year, the data only answered one of those two questions clearly.
Here's what actually happened in 2026. Bitcoin fell from around $88,000 to near $59,000, down roughly a third, driven by record ETF outflows, a symbolic sale from its largest corporate holder, and a technical breakdown that triggered hundreds of millions in liquidations. Gold, over that same period, hit a record high above $5,600 an ounce, supported by central bank buying and its much lower historical volatility. If this video changed how you think about either of these assets, hit that subscribe button. Every week on First Million Club, we break down exactly these kinds of real money stories, with real numbers, so the marketing pitch never gets the final word.